Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president, founder of Kuhn Capital Partners, independent registered investment advisory firm. And yes, we are a fiduciary. I want to thank everybody for listening this week. Hopefully everybody had a fantastic July 4th, enjoyed the time with whoever you find it important to spend time with. For me, it's family, and that was a really great break. Our job is to make sure that we're bringing you ideas on how to make money regardless of market direction. If you've listened to the show, then you know that we're headquartered out of the Chicagoland area. We're in Naperville, and we do run the show in multiple markets. So if you are hearing the show, please note that we do work with individuals in your area. We're very happy with where the radio show is going, and we continuously look to add new markets as we see fit. So if you have any questions on how to craft a portfolio that can generate positive returns in negative markets, if you have questions on lifetime income, if you have questions on significant tax reduction strategies, the easiest way to schedule an initial consultation with myself is to call Paige. Paige is our assistant. Her number is 630-492-1912, 630-492-1912. We've had a lot of great conversations. The last couple of weeks specifically, I've heard people who have listened to the show for an extended period of time, and I'm now just reaching out. And that's great. We're really happy that we can provide ideas, actionable ideas to you. As you know, if you've listened to the show, it's not cookie cutter. It's different than any other radio show that you're going to listen to on this station and most stations. We're going to bring you ideas that are actionable. Whether you implement them with us or not is up to you. But I think more so now than ever, I think we're at a very, very interesting time in the market. We've had a lot of client conversations about protection. We've had a lot of client conversations about if the markets do go down, how can we make money, or what do we have that can preserve principal? I think that's a job of an advisor, and for so many reasons. But specifically, we're seeing a lot of statistics here recently that are just showing just how potentially vulnerable this market is. And when we talk with individuals, I make a point to say that I have no idea what the market is going to do. You have no idea what the market is going to do. Our gut feels, or what our gut feels is going to happen is just candidly irrelevant because the market just doesn't care. But I am concerned. I do have concerns. And one of the things that my major concern is really just that individuals are not set up correctly to handle some sort of meaningful sell-off. And that's why individuals work with us. That's why individuals come to us. That's why individuals seek us out, is because of our belief that if we can focus on generating positive returns in negative markets, or at least preserving principal in negative markets for some of our money, then we let the up markets take care of themselves. And the markets are interesting. The top 10 largest stocks in the S&P 500 have contributed to about 77% of the index total return in the first half of 2024. Think about that. 10 stocks have contributed to almost 77% of the index's total return. The only time that has been higher was in 2007. And we all know what happened in 2008. And I don't share that with you to scare you. I don't want to scare individuals into reaching out. That's not who we are. Most individual financial advisors, it's just, and if we've talked in the past, I've said this to you multiple times. The way that an advisor manages their money, their personal money, their immediate family money, generally is significantly different than they are advising individual investors to manage their own money. And the reason being is it's hard to scale. They want simplicity. They want balanced portfolio. They want to use buzzwords that you've heard over and over and over again. Because when you introduce something new to the individual, it really just increases the sales cycle to getting them to become a client. And to me, that just doesn't matter. I mean, because when I see that 10 stocks are representing 77% of the performance, that's a lot. In 2007, the top 10 stocks actually represented 78%, almost 79% of the performance. And then, 2008 happened. And so, simple mathematics tells us if we can focus on generating returns in negative markets, preserving principal in negative markets, those are less gains that you have to use in future up markets to get back to even. That is so critical, and that's something that we preach day in and day out. So that we have tax reduction strategies that can greatly reduce your taxable income to the tune of 80 to 90% per $100,000 invested. If you have an interest in learning about that in the energy space, we do dinners throughout the Chicagoland area. Please get on our calendar, learn about when those dinners are, schedule a call so we can go over why we're able to target 15 to 20% distributions and why, while energy investing is still, I think, the only way to greatly reduce your taxable income, so much better than depreciation in real estate. So if you own real estate and you're used to depreciation, you're going to really, really love the energy strategy. Again, 70 to 90%. Last year was $90,000 per $100,000 invested. You were able to reduce your taxable income, active income, passive income, 1099, W-2 income. And we had targeted or the distributions on an annual basis are targeted in the 15 to 20% range, not directly dependent upon the stock and bond market. So a lot of interest in that, 630-492-1912. Some people think the economy is a dumpster fire. They do. I'm reading these headlines. The economy is a dumpster fire. Inflation, money printing, massive national debt, crazy politicians that offer limited to no solutions, at least solutions that don't appeal to half of the country. It's so interesting. And, Wall Street, the article I saw this week, and I thought it was a fantastic article. And it wasn't trying to just get clicks. It wasn't clickbait. It was written by somebody that I hold in high regard. But Wall Street is going towards a straight free-for-all. No one knows exactly what is going to happen. And I think there's a lot of truth to that. And that is a very, very big concern of ours, that nobody knows what is going to happen. And that doesn't mean the markets are going to fall. That doesn't mean the markets are going to go down 30%. That doesn't mean the markets aren't going to continue to just defy gravity and go up significantly, to higher valuations. But if you think about the top 10 stocks in the S&P are accounting for 77.2% of the return year to date of the S&P 500, what happens if those names kind of hit an air pocket and valuations start to matter and companies aren't, the momentum-based managers aren't just flooding a handful of names? What does that do to the market? Well, it's a concern. So I think if you talk to enough Wall Street executives and financial advisors that are kind of in the know, not just your traditional financial advisor, I think something is very unsettling. No one knows what is going to happen with the markets and, by extension, the economy. And candidly, it's scary. And I think when you don't know, it's hard to model. And I know what you're saying. There are guys that never really know what's going on, or they would have seen the 2007 and 2008 financial crisis months before it happened. And truth be told, they did see something coming. But most were too terrified to say anything, certainly say anything in public, while others, like hedge funds, large momentum-based managers, institutional managers, they didn't want to draw attention to their market bets. And so, no, this time is not different. Or is it different? And if you look at investing, those may be the four most expensive words in investing. this time it's different. So no, it's not different. But market prognosticators are all over the place because of huge policy-making mistakes, spending, money printing, and more that just skew the normal analytical tools. So in other words, I think what you have is the individual market prognosticator, those individuals that make a living trying to give individuals an idea of where the market is going. It's very hard to model what we're in. It's very hard to model the what ifs because so many of the traditional just ways of looking at the world, unfortunately, have changed. It's now anybody's guess to ultimately what is going to happen. So we know that our debt is absolutely off the charts. $1 trillion, I believe, is what it is just to service the debt on an annual basis. Maybe it can go on forever. I don't know. A lot of individuals think interest rates have to be cut just simply because of that. And there may be some truth to that. But again, you're dealing with decisions that are not or are very hard to model out what has historically been done. And so I'm very, very concerned that the individual investor who is working with what we call a traditional financial advisor, one that just simply has a buy and hold strategy and is using fixed income as a means of portfolio diversification, while fixed income is in the worst 4-year period in history, it's just not good enough. The equal weighted S&P 500, so as you know, the S&P is a market cap weighted index. So like I mentioned earlier in this segment, the top 10 stocks represent 77% of the performance year to date in the S&P. The equal weighted index, where the market cap doesn't affect the return either positively or negative in the index, it has underperformed the S&P 500 by nearly 10% over the first 6 months. One of the worst stretches on record, actually, if you go back to 1990. And so we have very highly credentialed analysts. And again, you know what they say about statistics, right? I mean, we all know that, or opinions, right? We all know that. But you have very credentialed analysts who are very well known on Wall Street that are calling for, something in the neighborhood of 15 to 20 to 25% decline in the near term. Near term could be by the end of the year, could be within the next 12 months. That's what most people, they just simply don't understand, or it's very hard to articulate when. But when you look at the Goldman Sachs Bull Bear Indicator, it's hot. It is very, very hot. And that's just a challenge. And so what my ask to you is if you're listening to the show and if you're managing the money on your own, I want you to think, what bucket of money do you have inside of your portfolio that can protect if the markets do go down 15 to 20 to 30%, or can even make money when the market is down? Those strategies do exist. If you're working with an advisor, if they haven't articulated that to you already, and if you don't at least know that, then you don't have any inside of your portfolio. It's the very first thing that we talk about when we bring on a new client. They know exactly what bucket of our money will protect and potentially grow in down markets. And so if that's not you, if you don't have that relationship in place, and if you want that relationship in place, if you want that additional protection, because really we think you win by not losing. If you lose less, ultimately you make more. We're not trying to outsmart the market. We're not trying to find the next Amazon, Apple, Google, Netflix, etc. We're trying to lose less, trying to make money when the markets are down. Then ultimately, that is how we're going to compound money. So hopefully you got something out of the first segment. The banknotes that we utilize, 12% still is pricing. So 12%. As long as the markets don't drop 30, markets meaning the index that it's tracked. So we have a lot of interest in that. If you'd like to have something like that inside of your portfolio, if you want to learn more, give us a call, 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. I am your host. My name is Robert Kuhn. I'm also the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. Our focus is getting people out of bad investments. That's one of our focus, especially if you own lifetime income annuities. Generally speaking, they just have not grown. We're having so many conversations with individuals who are being sold these lifetime income annuities, and they have not grown in any way, shape, or form. Talked with an individual who owned a very well-known annuity, and the first 3 years that they owned it, it didn't grow. The last 3 years that it grew at 3%, so that's 1% a year. And that's just not good enough. And we see so many people owning these lifetime income annuities, and there's no growth. Very, very limited growth. So one of our goals is to get people out of bad investments. If you own a lifetime income annuity, I want you to think about something. Your growth has probably been greatly limited because of the investments. They're volatility controlled investments. Bonds have been terrible, so that's one of the reasons that they have not grown. Number two, they meter your distributions. They meter how much you can take out in retirement. That is something that I don't think individuals fully grasp. If you can take out 4.5%, 5.5%, 5.75%, 6% today, what is that going to look like in 10 years, 15 years, 20 years? Is that distribution going to keep up with inflation? Chances are not a chance. And so insurance companies understand that there is no benefit of that lifetime income. Think about this. No benefit to your lifetime guaranteed income until that account goes to zero, because you are only taking your own money out of that account until the account goes to zero. When the account goes to zero, then yes, the insurance companies are going to start paying you. Is there a better way? We believe that there is a much, much better way. People want to say that we don't like annuities. Couldn't be further from the truth. We think we have the single best 5-year growth annuity on the market today that we're utilizing for clients. Currently, very simplistic. It's not tied to some volatility control, hypothetical, back-tested, unknown index that was just created. It's tied to the S&P 500. You've heard of the S&P 500. Currently, you get the first 11.5% of the S&P 500 growth. That's it. Very simple. From 0 to 11.5%, you get 100% of that return. On the downside, your worst year is 0. So if the markets drop 20, your return 0. They drop 50, your return 0. They drop 10, your return 0. So 11.5% on the upside, 0% on the downside. And when you get a gain in a year, the gain is locked in. You never give that gain back because you can't experience negative markets. Think about that. So you don't have to waste future gains trying to get back to where you once were. Where are we positioning that? Well, as a hedged equities, as a bond replacement. Phenomenal strategies, absolutely phenomenal strategies. So you can't say that we don't like index annuities, because I think that 5-year should be in many, many, many people's portfolio. If you're happy with 11.5% growth on the upside, currently that's what it is. You want that protection where you can't lose on the downside, and then you want that lock-in feature where when you get a gain, that gain's locked in, never to go back down, so you're not giving back those achieved gains. Probably a better annuity, a better, safe, managed strategy than a guaranteed lifetime income annuity. So if you want to learn more about that, if you have a lifetime income annuity and you want to get out of it, let's look at it. Let us see if there's any options for you. Far too many people are buying those when they just absolutely are not delivering in any way, shape, or form. 630-492-1912, 630-492-1912, and we'll do all we can to help you. Consumer sentiment, it's just totally wild. It's lower than during the bottom of the COVID crash. Consumer sentiment is done by the University of Michigan. It's exactly what it sounds like, what individuals think. And the markets, with the markets at near all-time highs, unemployment at around 4%, I think it speaks to the big bifurcation in the economy as the rich have gotten richer while the majority are feeling the pain. That is all that I can look at when I see that sentiment number, because I don't know. It's just, we're just in one of those twilight zone periods. And so many advisors want to scare people into making decisions. That's not how you do business. Again, I think the single greatest question you can ask an advisor or ask yourself if you're managing the money on your own, what do I have in my portfolio that I know won't go down or will deliver positive returns or can deliver positive returns when the markets are down? That's the single greatest question. If we can address that, if we can answer that, if we can always build a strategy around that, that is why individuals are reaching out to us. Whether you have $10,000 or $20 million, it doesn't matter. That is why individuals are reaching out to us. When you take into consideration our tax strategy on top of that, there's not a single advisor in the Midwest, or possibly, I don't know where, that is bringing you the comprehensive strategies that we are bringing. Strategies that can do well when the markets are down, strategies that can greatly reduce your taxable income, active income, passive income. That is why people are reaching out to us. So 630-492-1912 and get on our calendar. Again, why are we talking about this? Why are we doing the radio show? We're very, very passionate about helping people not lose money. Period. End of story. That is our mission. That is something that we take very seriously. I'm tired of traditional financial advisors talking about risk management, talking about diversification as a means of not losing money when the markets are down, only to have their portfolios, their clients' portfolios go down when the markets go down. Using fixed income, using bonds as a means of safety when we're in the worst 4-year period drawdown of the market in the bond market. And that's just not good enough, and it shouldn't be good enough for you. And I know the calls that we get because it's my firm. I know the downloads that we get because I see them. So the message is resonating, and we love the fact that we're working with clients who have 100,000, clients that have 500,000, clients that have $1 million, clients that have 10 million. Just because you got a bunch of money doesn't mean you should have all of the access to the most proactive risk management strategies, but that's generally how it has been. I encourage you, if you've got $100,000 to $500,000, you can invest the same way. We can put the same strategies together for you that the high net worth are using. And most advisors, unfortunately, especially those that advise in the $1 to $5 million or $1 to kind of $1 million space, they're just doing Me Too portfolios. Now it all sounds good. It all looks good. The charts look great. The advisor really, has great suits and says great, big phrases, and it makes, them sound really, really smart. But at the end of the day, you're just tracking the market up and down. And that's not good enough. And it should be good enough for you. It's darn sure not good enough for me. And I want to make sure that I'm expressing myself as candidly, as honestly, as forcefully as I can, that it shouldn't be good enough for you. So if you're not 100% certain that if the markets drop, which they could and they will at some point, nobody knows when, but as I mentioned in the first segment, 10 stocks represent 77% of the performance year to date. Goodness, if those stocks go out of favor, what happens? You owe it to yourself to make sure that you are protected. Period. End of story. 630-492-1912. 630-492-1912. Because hardship withdrawals, I think it's fascinating. But hardship withdrawals from 401k plans, they actually rocketed to nearly 40% as savers fight to just really save their homes, that they need money, and that is just an issue. So you have to look at who is making the money, right? The markets are at all-time highs. Who is making the money? You look at the S&P. So many people that we talked with are drastically underperforming the S&P 500, and it's just amazing to me that advisors can get away with just the excuses that they make. And I think it's because that individuals are intimidated. They don't have a very good working knowledge of what the market is and what the market does. And so they have to rely upon the same old excuses, the same old strategies. When you look at what institutions are doing, when you look at what endowments are doing, I mean, it's a challenge. I mean, the S&P 500 was up 14.5% for the first half of 2024. That's the 15th best start to the year, going back all the way to 1928. Many individuals came nowhere close to that this year, just in 6 months. And so we just want to make sure that we're bringing to the table things that I personally would invest in, advisors would personally invest in. Generally speaking, what we find is somewhere in the momentum-based strategies that track momentum, strategies that don't care about where they're invested. They want to go to where the money flow is going. Simple supply and demand. Money flows comes in, prices go up. Money flows out, prices go down. With computers today, it's becoming much more accessible, not just to the ultra high net worth. It's really accessible to everybody. Candidly, everybody. 10,000, 50,000, 100,000, 500,000, 5 million, 10 million, 20 million. You can now invest in these same types of strategies where you don't just have to try and find, okay, well, let's go through a bunch of stocks and let's find stocks that are trading at a discount that the computers haven't found. Well, good luck with that. When you have computers, you have AI that can identify and go through 6,000 data points in a second, 6,000 pages of information in a day. I mean, they can just do things that you and I simply can't do. And the question is, do you really care where your returns are coming from? The days of wanting to own small cap, large cap, mid cap, growth, value, international, emerging markets, et cetera, those days are so over. So over. And if you are still owning, and if you still have that type of a buy and hold strategy, if you're still working with an advisor that believes in that, I promise you they're not managing their own money that way. I'm almost certain of that. Why is it good enough for you, right? Why is it good enough for you? And it shouldn't be. And, we talk a lot about the bond market. And as of the end of June, the bond market has now been in a drawdown for 47 months. This is the Bloomberg U.S. Aggregate Bond Index. So going back from 76 to 2024, the bond market is now in a drawdown for 47 months. August 20th till today, the max drawdown during that period, 17.2%. So this. You know that in 2022, when the S&P 500 was down, and the bond portfolio that you had that was supposed to protect, that your advisor says this is the most cutting edge way to manage risk, it was probably down 15 to 20% as well. So that's an issue. That's absolutely positively an issue. It's an issue that you have to make sure you address and plan for. Not good enough. Just not good enough, especially when the S&P 500 has made 31 all-time highs this year. That's only through the first half of the year. So what does that mean to you? What does that mean for your portfolio? We talked about being able to make money when markets are down. That exists. We talked about that 5-year index annuity strategy as an alternative to a lifetime guaranteed income annuity. That exists. We talked about ways to mitigate interest rate risk. We've talked about that forever. And so I'm proud to say that our clients just didn't, they have more cutting edge risk management strategies than just bonds. So that being said, give it some thought. We'd love to have that conversation with you. Yes, we're financial planners. Yes, we believe in income maximization, tax reduction. We definitely believe in income planning, financial planning. It's the core of everything that we do. But I want to make sure that that's not why you're working with an advisor. You work with an advisor because we have strategies in place that can deliver positive returns when the markets are down. Period. End of story. If you want to get on my calendar, give Paige a call, 630-492-1912, 630-492-1912. You're listening to Destination Retirement. Thank you for joining us this Saturday. Hopefully everybody had a great 4th of July. Hopefully everybody's having a great start to their weekend. I want to thank everybody for listening. If you're catching this on the podcast, thank you. Send it on to somebody that you may know that needs to hear our story. Those are obviously, it is very, very appreciative because what we're bringing to the table is totally unique. especially if you consider our tax strategies, tax reduction strategies. Again, the role of an advisor, let's have strategies in place that can make money when the markets are down, have strategies in place that can protect principal when the market is down, and then let's let the up market take care of themselves, albeit past performance is not indicative of future results. So I want to make sure that I'm very, very clear on that. But one of our strategies, which is our all cap and focused growth strategies, that strategy has outperformed the S&P 500 significantly since 1995 to the tune of, well, it's just a lot. 2.5% a year adds up over time. And again, past performance isn't indicative of future results. That being said, you can outperform the market. You can beat the market. The challenge is people are just using buy and hold strategies. They're using fixed income as a means of portfolio diversification. Well, then they're just not going to do that, generally speaking. So if you want to learn more about that, you want to learn about our tax reduction strategies, if you want to learn about our income notes that are backed by the largest banks in the world, currently they have been pricing in the 12 to 13% annual rate of return area. Those distributions or those coupon payments are paid monthly as long as the indexes that it is tracking do not go down 30%. Or another way to look at it, you have 30% downside protection, but to make 12 to 13% a year, those are things that I want people calling in and talking about, and they are, and I love that. The last 2 weeks, it's just warmed my heart to hear people call me and say, hey, I want to learn more about that income bank note that pays 12%, 13%, 13.5%, whatever the note price is at, that you get as long as the markets don't drop 30%. And by market, I mean the indexes that the note is tracking. Those investments you used to have significant wealth to get access to. We started doing them in the early 2000s. This is something we've done in the course of business throughout my career. Today, the minimum investment for that note is $1,000. So it's for everybody. 630-492-1912, 630-492-1912. We talk a lot about valuation, and we talk a lot about, really, we use valuation in life. You know when you buy something, if you're getting a deal or not. You know if you buy a house, if you're getting a deal, a car, if you're getting a deal, if you're getting a sale on clothes, food, whatever. You're concerned about valuation. You're concerned that you are getting a fair product or purchase for the price that you are paying. But yet when it comes to the market, an advisor is the absolute worst. The absolute worst, because they're running a business. So when they get a new client, they're just going to put them in the same strategies that they've been using for all of their other clients. Doesn't matter what the risk return is at that time, but valuation is very, very important. And that's a way that we look at the market. It's a way that we look at, is the market cheap or is it on sale? And the NASDAQ is now the most overbought since right before 2018, when there were some issues. And when you look at that, that is somewhat of a concern. Again, it just looks at, so many individuals want to look at where the market has been. They want to look at what makes them feel comfortable. Is they want to get in after it goes up. So the market goes up. Okay, now I'm comfortable to get in. Well, that's not the time when you should be comfortable. The time that you should be comfortable is when there is a lot of panic, when there is a lot of blood in the streets, as they say, when the market is down significantly. The time that you want to get conservative, or the time that you want to realize some gains and protect those gains, is in periods like we're at today. I mean, when you look at hedge funds, and you look at, generally, we talk a lot about hedge funds, and we look at, what the hedge fund market, the hedge fund space is doing. One of the reasons why is because generally the manager of that fund, the bulk of their personal net worth is in that fund. And you're going to get a different opinion when the bulk of their personal money is invested directly alongside of yours. That's generally when you're going to get an honest opinion of what the market is going to do. But we have, there's been a move, and the move has been swiftly back into a net short territory for the S&P 500 futures. And that's, again, one of the differences between hedge funds and institutional money is they'll change on a dime. As the data changes, they will change. But when it comes to individual investors and sadly, traditional financial advisors, they're never adjusting that allocation, or they're only adjusting that portfolio allocation when you call them or when you have a review. So does that mean that that's the only time that you should adjust their portfolios? I mean, that's goodness, that is a concern. And again, I guess nothing matters if the markets are going to continue to go vertical, but that's a tough game to play. And I think it's when we look at, 401k plans and IRAs, they comprise 55% of total wealth for many high net worth individuals. And that is something that I want you to really think and take a look at, or just really absorb. If you have a lot of money in your IRA and you're over 59 and a half, what is your distribution strategy? How are you going to take that money out of that IRA as tax efficiently as possible? Because when you take money out of an IRA or a qualified plan, it's ordinary income in that year. It just is. The government wants you to pay taxes on it. Ordinary income. It's like W-2 paycheck income. You take out a $100,000 distribution, it's $100,000 of ordinary income that you're going to have to now pay tax on. So when we look at kind of Roth conversions, and that's why, Roth conversions were so popular. Now that's so dated, of course, but you take that money today, pay the tax today, put it into a Roth, and then the money you don't pay taxes on any of the gains, at least as the tax law states today. Most individuals think taxes are going up, maybe significantly higher. So if you've listened to the show for any length of time, you know that we think the most overlooked area of financial planning is tax strategies that can greatly reduce your taxable income. So what we've been talking with a lot of individuals who have a lot of money tied up in IRAs and qualified accounts, that let's take a distribution of that IRA. Let's invest it in a strategy that last year, if you took a $100,000 distribution, invested it in the KCP Energy Fund, you reduced that distribution, the tax on that distribution, from $100,000 to only $10,000. So instead of it looking like you took out a $100,000 distribution, well, you invested it in the KCP Energy Fund. You had almost $90,000 tax benefit. $100,000 distribution, $90,000 tax benefit. Your new net distribution is only $10,000. Think about that. Oh, and by the way, you're investing it in a strategy that's not tied to the S&P or the bond market directly. And it has targeted distributions in the 15 to 20% space is what we target those annual distributions to be. But think about that. I just gave you a way to tax efficiently take down that IRA. Go find another advisor that has access to that strategy. It doesn't exist. And, well, there are energy strategies out there. I shouldn't say it like that. We'll take it to the next level as investing it in an energy strategy with the predictability of the strategy that we have. Let's leave it at that. But strategies that can just greatly reduce your taxable income. So you're able to take that money out and legally not pay taxes, additional taxes to the government. Now, I'm not a tax advisor. Again, as we say, and we preface everything, we believe in transparency. We're financial advisors. We can't provide tax advice. Legally, we can't provide it. So these tax benefits are very black and white, but it's always best practice to make sure that you talk to a tax professional. But again, in the energy space, they're very, very, very black and white. So if you have a large IRA, you want to get that money out as tax efficiently as possible. Let's talk about the energy strategy. If you make a bunch of income, and normally north of $500,000, $1 million, $2 million, $3 million a year, if you have significant capital gains because you sold a business, sold a building, sold a property, sold stock options, what have you, let's have that conversation. Let's have that conversation on how we can greatly reduce that tax liability that you're ultimately going to have. 630-492-1912. 630-492-1912. Easy money. I'm often asked, has the easy money already been made? And, based on my experience, post 2008, yes, I think a lot of the easy money has been made. I think that it is going to get significantly harder to make money, to see significant gains going forward, not looking backwards. I do think a lot of the money, easy money, has been made. What that means to you is you have to be working with somebody that has the most proactive, cutting-edge strategies, not only for growing your money, but also for protecting your money when the markets are down. And we're pricing, we do price, 2 or 3 income notes a month. So if you have any interest in that, make sure you give us a call, 630-492-1912, 630-492-1912. The last 3 that we've priced, they've all been back. They're all backed by, a Citigroup, a Bank of America, J.P. Morgan, Goldman Sachs, UBS, Morgan Stanley, a bank that's too big to fail. Those are the banks that we're dealing with on the income notes. Last note we priced was 12%. So you receive 1% a month as long as the indexes that note tracked did not drop more than 30%. So basically you had 30% protection to make 1% a month. The note before that was 13. The note before that was 13.5. So they generally range, in the 11.5 to 13.5% range. But there's so much comfort in having a strategy inside of your portfolio, whether it's 5%, 15%, 30%, 40%, whatever, that can still make money as long as the markets don't breach a level on the downside. The level on the downside that we use is 30%. So as long as the indexes that note is tracking are not down 30%, you're going to get that annual coupon, whatever it is, and you're going to get paid 1/12 of that every single month. So those are the things that we want to talk about, especially in these markets, especially where the markets are today. And these are relatively short-term investments. Look at it as just a hedge to what you're doing, right? And if you don't believe me, believe J.P. Morgan, believe Bank of America, believe Citigroup, believe UBS, believe Morgan Stanley, believe BMO. I mean, these are backed by those banks. You actually have a prospectus. It is a senior unsecured debt of the bank. So as long as that bank is around, those investments, those parameters, those predetermined outcomes are going to be adhered to. So, again, just taking it to that next level, just taking it to that next level of risk management, just taking it to that next level of not a cookie cutter portfolio. And you deserve it. It's your money, hard-earned money. You deserve an advisor that's going to use the most cutting-edge risk management strategies available. You don't need to work with an advisor that's going to talk about balance, that's going to talk about time in the market, that's going to talk about, blah, blah, blah. And you know what? They're managing their own money differently, but yet it's okay for them to suggest cookie-cutter portfolios to you. For us, it's not. 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. Thank you for joining us this week. Hope everybody had a great 4th of July. We are a fiduciary. We are here to provide the knowledge for you to make sure that you know that you can work with an advisor that can implement strategies that can protect principal or even deliver positive returns when the markets are down. That is something that I think is the very, very most basic question in interviewing advisors, or if you're working with an advisor. How can we make money? What do you have inside of my portfolio that'll deliver positive returns to a point if the markets drop? As you know, we use a 30% downside protected bank note offered by the largest banks, and it's something that we have done for years and years and years. So our pricing, generally, given the volume that we are going to do, we could do the same note, but we're going to, generally speaking, give you better volume or better pricing just because of the volume that we do, and that does mean something in this space. Again, 30% protection to make 12. That was the last note we did. 1% a month as long as the index that note tracks are not down more than 30%. Very, very significant strategy. A couple notes before that, 13.5. One we did was 13, so they're all over the board, but generally they're very, very high. Very nice, very reassuring to know that you have something like that in your portfolio. If you don't, give us a call, 630-492-1912, 630-492-1912. We often hear recession. I don't know. Sometimes I think, well, I know that advisors in Wall Street and the media, they like these big, scary words, and it just gets clicks, it gets eyeballs, it gets, you just send it to friends, and I think that's all anybody wants these days. But yeah, there are some issues that are concerning. There are some issues, especially in the recession space, that have me concerned, especially towards the tail end of last month. The U.S. leading economic indicator, LEI, it's actually down 14.7 from this economic cycle peak. And that might not mean a whole lot to you, but in the last 65 years, such a drop has only happened during recessions. And that index, as you may wonder what it is and what it's not, it takes into account U.S. labor market data, manufacturing sector data, building permits, S&P 500, and bonds. And yeah, we saw a very big drop. And again, we always hammer statistics, right? You know what they say about, opinions, you know what they say. But statistics, you can basically craft any message that you want. So we're just looking at statistics that they just are what they are, right? And anytime I see statistics like this, so you had this economic indicator, right? It drops significantly from the peak, cycle peak. And if we go back in time, 65 years, such a drop has only happened during recessions. So is a recession really that bad? I guess that's the question that you have to ask. Is a recession really that bad? And the answer to that is yes, if you're working with a traditional financial advisor that only utilizes stocks and bonds. I am so tired of advisors talking about balanced portfolios and diversification and asset allocation as a means of risk management. I guess it is a means of risk management, probably far, far, far down on the list that I would use as risk management, but it is a means of risk management. But yes, I would be very, very concerned about a recession if you're not working with an advisor like us, an advisor that we believe have the most proactive strategies in place that can reduce your losses when the markets go down. Isn't that simple math? If I lose less, ultimately I make more. That's a simple mathematical equation that we've subscribed to for really probably since I've started providing financial advice in some form or fashion going back to the late 90s. And lose less to make more. The challenge is most advisors will say that. Most advisors will talk that. Most individual clients don't have the confidence to ask an advisor what bucket of my money will do well or even make money when the markets go down. Show me that. Most clients won't ask that because this just isn't your business. So you rely upon the trusted financial advice of a professional, but yet your portfolio only goes up with the market, down with the market, up with the market, down with the market. And right now we're in an up period. So you may think you've got the best strategy in place, the single best strategy in place. But really, do you? And I could look at it really quickly and say, nope, not at all. It's just the market. Market's going to take it up, but guess what? The market's going to give it all back, and the market's going to take it all back down. And that's why we get on this roller coaster ride of Wall Street, where if you're working with a traditional financial advisor, not a cutting, forward-thinking, proactive manager that brings the most cutting-edge risk management strategies into your portfolio, that's why you're on that roller coaster. Markets are up, we're down, we're up, we're down, we're up, we're down. Now we're in a heck of a period, a heck of an up period. But again, If you listen to the show, you know the statistic that I'm about to give you. Had you bought Microsoft in 2000, it took you 12 years to get back to even. So I want to ask a question. If you're in your 50s, your 60s, or 70s, what happens if we see that market again? What happens to your portfolio if we see a sideways market for 3 years, 5 years, 7 years, 10 years, or 12 years? I mean, we're not going back to the Stone Ages here. We're going back to the early 2000s. If you bought Microsoft in 2000, it took you 12 years to get back to even. Now, if you're an astute investor or an advisor that's listening, you may say, well, you're cherry picking the dates. Well, of course. Yeah, we are. Right? Yeah. You started in 2000, bought Microsoft. We had 01, we had 02. Obviously, we know what, well, 01 and 02, we know what happened during those markets. Then we had 08, right? And then the markets ran back up. Well, what happens if we're in that period today? You don't know that if we're not. I mean, if you look at the valuations in the market today, they're very, very stretched. Now, it doesn't mean that they can't become more stressed, but if you believe that everything ultimately reverts back to the mean, that means we may be due for some tough times. So I want you to ask yourself that question. What do you have in your portfolio that can protect when the markets are down? So we all know NVIDIA, right? You've heard of NVIDIA. Probably have heard of NVIDIA. You may not know what they do, but you've heard of that stock. As of a couple weeks ago, NVIDIA was worth more than the entire stock market in France or the UK. That is just crazy. I read a statistic that NVIDIA, 75% of their employees are millionaires because of the stock options. And it really just, what am I trying to get, by saying this? What am I trying to get you to walk away with? Well, it's this, that the computers can generally do better than managing money because they're non-emotional. My gut feel, we would have been out of NVIDIA 1,000% ago. I mean, really, it just can't keep going up. But it does. And it did. And it continues to. Now, we pulled back some, of course, here in the last week or two. But one of the benefits of utilizing a momentum-based strategy and managing your equities is that the computers don't care. The computers just want to track where the money flow is. And they want to participate until the money flow starts falling and going away and moving out of those names. It's so simplistic. Now, it may have 50,000 lines of code. The algorithms may be super, super complex. But I want you to hear me. They're not trying to get in at the bottom, out at the top. They're just trying to track where the money flow is going, where the institutional money flow is going. It's kind of like a Ponzi scheme, to be honest with you, where Wall Street, with the big hedge fund money, the big institutional money, they bid up a bunch of stocks. And as the retail investors start to come in, guess who's selling? Wall Street and the institutional money. We love momentum. While it's not perfect, there is no perfect strategy. It is very, very good. And I will put that strategy up against anything that you're doing if you're in a buy and hold strategy that's trying to own large, mid, small, growth value, emerging markets, etc. You're not still using the cell phone from, heck, probably even 5 years ago. Why are you still using a risk management strategy from the early 2000s or really even maybe in the 1990s? Hopefully everybody got something out of this show. Our job is to make sure that we give you actionable ideas every single week. My name is Robert Kuhn. I want to thank everybody for listening. If we can help you in any way, any form, any fashion when it comes to your investments, your retirement, your tax management, your income plans, please feel free to give us a call. Get on my calendar. You can call Paige, 630-492-1912, 630-492-1912. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.